All right. My name is Chris Campbell. I'm a practicing CPA and I work with small to mid-sized businesses and individuals to help them pay the least amount of taxes possible while keeping them out of jail. So today I wanted to talk about a situation that may trigger the need to file a tax return in the middle of the year. So we've been trained to have certain tax dates in our head, right? So, you're April 15th, right? But you have to have your taxes filed. And then if you have either a corporation, well, specifically an S Corp or a partnership, you have March 15th date in your head. And then if you file an extension, you've had 6 months each of those dates. So you normally file an extension and you're part of a partnership or an S Corp owner, you're pushing your date back to September 15th, right? And potentially October 15th if you have a regular C Corp. So those are the dates that, for the most part, are ingrained in folks' heads. But there can be a scenario where your filing date may change, right? And mainly that's a result of what happens when you have what's called a short tax period. Now, a couple things can trigger that. Before I get into that, you'll have what's called a short tax year, right? And it's pretty much self-explanatory where most folks operate on the calendar year, but there might be instances or scenarios that are created where you have a tax year that ends before the regular calendar date, right? So a couple of things can trigger that. What could be a short tax year is that you shut down the company mid-year, right? So if the company ends sometime in the middle of the year, your tax year is over, right? So if you have a company and you decide to shut it down and say it's effective April 30th, well, your tax year ended on April 30th, not December 31st, right? So that creates a short tax year. If you were to change entities, and I'm going through these scenarios because these are a few scenarios that happen with different clients that I've had. I had a client recently convert from a partnership to a C Corp, and they did it mid-year, right? So the tax year for the partnership ended on the day that it was converted, and then the tax year begun for the C Corp on the day that it converted, but you still use the same year end, right? December 1st for the corporation. So the short tax year, for the most part, is triggered when it's less than 12 months, but the end date is something other than December 31st. Because then let's say you start a new entity in the middle of the year, that's not necessarily a short tax year because you're still using the same end date of December 31st, right? It is shorter. It's not a full 12 months, but the entity didn't exist prior to. But for the most part, you're considered a short tax year if it's less than 12 months. The ending date is other than December 31st. Now, after explaining all that, if you're in one of those scenarios where you have a short tax year, another thing that can create a short tax year is if you move. So I've come across this recently with a client where they moved states. So they relocated from one state to another, and their move date was considered the end date. They moved, in this particular instance, they moved from New York State to Washington State, and their last day in New York State, that created the short tax year. So you have to file a short tax year for that year. Now, this can create a different tax deadline for you if you're in a scenario where you have a short tax year, because of the rules that the most states and the IRS tell you about as far as deadlines for filing is they don't set it by the specific date, right? Because as I started this video telling you that we have certain dates ingrained in our heads, but if you were to go into the tax law, those dates aren't necessarily in the tax. What's in the tax law is they say, okay, it's 2.5 months after the end of the year. So because most folks file using a December 31st end date, 2.5 months is March 15th. So that's where we get those dates ingrained from. The tax law is 2.5 months from the end of the tax year. Now, if you have a short tax year, that's where the new filing deadline comes in because you have to go 2.5 months from the end of that tax year. So if you have a short tax year, and let's say it ends in that you have 2.5 months from the end of April to file your return. Why did he do it beyond that? It's late. So I wanted to walk through all of that, explain that, because I've had a number of clients that have come and they've gone through these scenarios, and I may talk to them, let's say once a year, and they come and they do their taxes and they're like, yeah, well, I moved in the middle of the year. and then they're looking to have their taxes done for both states, something that I wasn't necessarily aware of. And then I have to let them know, like, well, from the state that you moved from, more than likely have filed late. It's too late, because once you make that move and you end your business in that state, the clock starts to 2.5 months because you're in the third tax year. And then you're late like that, then it triggers all sorts of penalties. So the takeaway here is knowing what may trigger a short tax year, and then what may trigger an earlier deadline to file the tax that you're used to. So make sure to just take heed that your filing deadline may come early as a number of those circumstances. So if you don't file the return or file the extension by that new date, you face the risk of late filing penalties. A couple clients of mine recently got jammed up with something like this, so I figured I'd share it and put it on the radar. All right. So that's all for now. Hopefully this helped. If you have any questions about this topic or any other tax or account related questions, please feel free to reach out. I'm happy to help. All right. That's all for now. I'll talk to you in the next one.